The mathematics is as simply as this. The USA right now at historic low interest rates is barely collecting enough US tax revenues to cover its interest expense 100%, which means if interest rates rise, which they are likely to rise since the Fed is pushing short-term interest rates higher, the average funding rate for the USA is going to increase, and that will lead to higher interest expense, which will in turn lead to the organic growth of the US debt outstanding just because of interest. The USA collects $4 and change trillion annually in tax revenues. And mind you, that has been augmented lately because of nice capital gains increases in stocks and assets. They collect $4 trillion. They have a fixed cost base that includes entitlements and military spending. And the combination of entitlements and military spending is in the area of 3.6 trillion, which leaves the balance of the tax revenues to pay for the interest expense. Now, the USA has $30 trillion of outstanding debt, Joe. And right now, their average interest expense is about $400 billion annually, okay? But that's at historic lows. The average interest rate that they were paying, if you do 30 trillion divided by 400 billion, is around 1%. But that's likely to rise to 3%, right? Because the Fed funds rate is, US 10-year rates are now, 10-year treasury yield rates are now 3%. And the shape of the yield curve and the funding, the blended funding costs is going to cause interest expense to increase so that they will not even cover their interest obligations, expense obligations, with the residual tax revenues over entitlements and military spending. So it basically means that debt spiral is growing organically and can be quite severe if the Fed has to push rates significantly higher just because they're fighting inflation. It all leads to my opinion that quantitative easing, QE infinity, is in the offing. There's no other way to solve the debt spiral. And I want to throw this out. It's important because there's other people doing great research. So I mentioned James Lavish, Luke Groman, absolutely on the same page. What a lot of people fail to appreciate, Joe, and this, I spent my entire life trading credit, junk credit to be exact. If a corporation had the same financials as the USA, it would be rated CCC. Full stop. Full junk credit, CCC rated. That's pretty scary, isn't it? Because CCC rated corporations do not cover their interest expense or cover their interest expense anywhere between 1 and 1.5 times. That's the USA right there. And it's soon to be covering it less than 1 full turn. This is not a good situation. It's very scary. The rating agencies give the benefit of the doubt and say, okay, well, these guys do have the ability to tax and they do have the ability to print money. But nonetheless, it's my opinion that the credit risk of sovereign nations is severely under, as we know, in my opinion, is Bitcoin. Bitcoin can be thought of as an insurance on misunderstood, and we need a solution. The solution is sovereign debt spirals. It's not a pretty picture. I just saw some math on Canada, my home country, in total debt to their GDP. So this is a global phenomenon today that put Canada in the bottom of, or in the they were the top performer of the zombie nations in terms of adding. It's extremely dangerous because once confidence is lost in the sovereign debt of a nation, it quickly cascades right through the markets, right into corporate lending, into structured products, into the commercial banks. And that's the beginning of the end, essentially. I believe they're already walking back expectations to get to that rate. I believe that concert with a reduced inflation target excuse me, not reduced inflation target, an increased inflation target. So moving from a 2% annualized inflation to, let's say, 4 or 5% annualized inflation will allow them to seek cover and say, okay, mission accomplished, inflation's under control, and then quietly say, yeah, it's no longer 2% annualized, we're aiming for 4% annualized. So again, got to be careful. How do you define pivot? I think I know how Luke is defining it, and it's aggressive. To say that the Fed will pivot by September, I believe is aggressive. That being said, if we define pivot as a change of the inflation target, if we define pivot as saying, okay, we're not going to get to 4.5%, we'll probably get to 3.5%, maybe 4%. Yeah, I think we're in the process of that. There's an old trading adage, 3 hikes and a stumble. And we're experiencing the stumble right now. Global risk assets are balancing on the head of a pin. And if you lose confidence in the markets, you'll argue that the Fed has, they have 2 distinct mandates. One is full employment and the other one is control inflation. Now that in itself are 2, those things are somewhat working at odds. But the third one is financial stability. If the U.S. Treasury market starts to seize up because bid-offer spreads widen and confidence in the U.S. Treasury as a quote-unquote reserve asset starts to wane, I think, I think you'll see the Fed have to understand the pure math of it. Yes, we will have to accept inflation. Yes, it's going to be a reality going forward. There was actually a Wall Street Journal article saying that, and Wall Street Journal tends to be the leaky, that's how the Fed leaks out their case. So many things to me point to the pivot is in progress. That being said, I have never met a group of poor poker players in my whole life that probably are getting their back up a little and like, oh, they think I'm bluffing, eh? They think I'm bluffing. Well, I'm going to show them I'm not bluffing. And then all of a sudden, emerging markets continue to create